I'm Robert Newstead. I'm the founder of Guardrail Finance. I'm also the founder of Cashflow Net Worth. With Guardrail Finance, we offer real estate syndications, we offer commercial real estate financing services, and we also offer education through our media group, Cashflow Net Worth. Now, Cashflow Net Worth has basically been started by me because I was tired of the hype. I was tired of everything that people were offering and promising in real estate syndications. And I was also really tired of seeing that too many of my friends, my family members, my colleagues were not improving their cash flow and their net worth through real estate syndications, especially during the bull run up since the great financial crisis ended. And now we're in a transition period. And my thinking has been that I want to provide some real education without all the fluff, without all the BS, so that you can actually have deals that you understand, get them vetted in a clear way, understand what the deal is, what the business plan is, how the sponsor is going to execute on it, have some background information on the sponsor and what types of deals they've done, and be able to vet the sponsor as well. And then also cover the market so that you can see, is this a market that's growing? Is it a market that has job growth? Is there in-migration? How are the taxes in that area? You want to be able to look at a lot of different things that I like to call red flags prior to even deciding whether you're going to invest. Now, I'll be the first to tell you, I also sometimes get the shiny bauble syndrome. I love real estate deals. I love investing in real estate deals, both as a GP, as a co-GP, as an LP, and also through funds. But I've become more and more particular, especially over the last couple years, because we've had significant inflation run up, which has significantly impacted real estate. The other thing that I've noticed is that with the interest rate increases, I'm seeing a lot of sponsors who are going out into the market. They're doing capital calls. And look, I've been party to a bunch of capital calls over the last couple of years, but not all of them are doing it with clarity. Not all of them are doing it with explanations about why the capital call is needed, what the benefit of the capital call is, and how you're going to be impacted from a cash flow perspective once the capital call is done. Does your situation improve? Does your situation stay the same? Does it get worse? There are capital calls that I have decided to do, and there are capital calls that I've decided that I'm not going to do. And from my perspective, I want investors to have that clarity because it is a hard business. Real estate investing is not easy. And look, I call it real estate limited partnership investing, passive income, passive investing. It is on some level, but at the end of the day, it's your money. It's your money. So you need to be doing the analysis and say, is this deal right for me? Is this the right sponsor to be investing with? Is this the right market for me to diversify into? You need to be asking yourself these questions all the time. And I have a 4-part framework that I use. The first thing I do is I build my investment thesis. And I think that is the most important thing that you can do as well. You need to know, how much money do you have in cash, in self-directed IRAs? What money can you invest every year into new deals? And then that gives you a baseline. If you can invest $25,000 in a deal per year, you know that you are looking for the deal that you think is the most optimal for your situation. What else are you looking for? Are you looking for cash flow? Are you looking for growth? Are you looking for high multiples? You need to be understanding what the most important factors are for you in a deal. The next step of the framework is the diversification strategy. And I am a big believer in diversification. I know some people will tell you that they think it's more important to specialize in one asset, one market, but I've always viewed that money is my product and real estate is part of that. You need to understand the real estate, but the real estate is immovable. And I view money as my product because the money can move across boundaries, across borders. I've invested in over 30 states and I've invested in over 10 countries. For me, I would much rather have my money work in multiple markets and get diversification by asset type, by product type, by geographic market, and even by sponsor. And I say this because I'm a GP. I've also acted as a co-GP, and I'm an LP. And now I'm looking at setting up a fund of funds because I also believe that there are other sponsors deals who I know, like, and trust, who I would like to raise money for. And I'd like to help them grow. And then I want to also work with our investors so they feel comfortable to invest in my deals when I bring those to the table. So that's the second step in the framework. The third step in the framework is what I call the equity leverage method. And the equity leverage method is quite simple. Most of us understand leverage. Leverage is taking debt at the property level. Well, at the property level, there's also another layer in the entity structure. So the entity will be set up where you have your general partners and you have your limited partners. And a lot of times the limited partners have a minimum investment amount. Call it 25,000, 50,000, 100,000. What I view is if you have 100,000 that you would like to invest over the course of a year, I would posit that it's better to invest in 4 deals with 25,000 than it is to invest in 1 deal with 100,000. Now, sure, there's some additional costs, there's some additional research on your end, but I believe that that is the better source. You're diversifying your cash flows, you're diversifying your markets, you're diversifying your asset type, and once you find sponsors who you know, like, and trust, you can be diversifying by sponsor as well. And so the equity leverage method basically is you're leveraging your equity with other people's equity and generally with a sponsor where you're doing a larger deal than what you would normally do on your own. The fourth part of the framework that I use is called the AIR method. And the AIR method for me is simple. It's just a reinvestment loop. And so the A stands for analyze. And so you want to analyze the deal. You want to analyze the market. You want to analyze the sponsor. You are basically getting into it because it is your money. You need to know what is going on in the nuts and bolts, what the business plan is, what assumptions that the sponsor is using. Are they using blue sky assumptions where the rents right now are $5 a square foot and they think they can get to $9 a square foot, but the market is really $7.50 a square foot? You need to understand if they're making pie in the sky assumptions or if they're accurate assumptions that you can depend on. The next part is invest. So you have to invest. If you're not going to invest, you're not going to get the cash flow, you're not going to get the upside, you're not going to get the diversification, and you're not going to get the equity leverage. So you have to make a decision with your money based on your investment thesis. Is this the right deal? Is this the right deal for me? Is this the right deal for my family? Is it hitting the marks that I need to get? Is it adding to the cash flow that I need to get, the passive cash flow that I need to get every year? And if it is, and if it's in a market that you want exposure to, and if it's in a property type that you want an exposure to, and it's with a sponsor who you know, like, and trust, then you should invest. Or you should make the decision, yes, I'm going to invest, or no, I'm not. The first R in the AIR method is to reap. And so what I mean by reap is that at the end of the hold period or during the hold period, you may have a chance to refinance and get some cash out. That is a reap. Another thing is if you sell the property, then you have the ability to reap the profits and get your equity back from the sale of that property. And so that is the first R in the AIR method. And I think it's hugely important. If a sponsor sells the property, there are options. There are obviously tax consequences, things like that, but there's also ways to shield that. If the sponsor has an equally good deal that they can roll the entire investment into and all of the investors decide that that's a good idea, you could roll into a 1031, and then that way you're getting back to a cycle where you can analyze that deal and then reinvest. And that's the second R in the AIR method. So that's AIRR. And the reinvestment loop is important. I look at the reinvestment loop in an iterative fashion because all the while that you're holding onto a property, a cash flowing property, you'll be getting distributions either on a monthly or a quarterly or semi-annual basis. When that property distributes to you, you can decide what to do with that. You can live off of that as passive cash flow and cover your expenses, or you can take that money if you don't need it immediately and reinvest. And then you're back in the whole iterative loop again where you need to analyze, decide whether you're going to invest, reap at some point, and then do a reinvestment. And so this becomes an iterative loop that I use for everything. And I don't always 1031. Sometimes I take the profits from a deal and I'll put them in cash because I don't think the next deal in a 1031 is as good as the one I was getting out of. There are times where I will 1031. And there are times where I have invested in my self-directed IRA and just out of a matter of policy, I say no because it does not impact me. I don't have an immediate tax benefit by doing a 1031. And in some cases, I feel like I'm taking on more risk because the IRS gives restrictions and limitations on when you need to invest by. And so I don't want another sponsor doing a bad deal just to save on taxes. I'd rather pay the taxes and move on, especially if it's in my self-directed IRA. If I can, if I can save money from a tax standpoint with my cash investments, then oftentimes I'll look at that a little bit harder, do a little bit of analysis. I might be losing on the cash flow side, but I may be gaining because I'm not going to have a, six-figure tax bill that comes from taking profits from a deal. So these are different things that you need to look at when you're investing. And now I figured I'll give you a little bit of background on me. I have been in the real estate space since 2003 officially. I did start before that, but I was working on partnerships for tech executives in the Bay Area. And then after 4 years of doing that, I decided that I wanted to go all in on commercial real estate. And I joined up with a boutique firm. I was operating out of Hawaii at the time, and this firm was doing a mix of mortgage banking. They were also acting as a merchant bank, so they had a fund where they were acting as a high yield debt lender for local projects in Hawaii. And then the other thing they were doing was taking on projects where they were going to be the sponsor and they were going to take co-investment money to do real estate limited partnerships, mostly in the Hawaiian markets. And so I got a nice taste of, from a boutique shop, all the different things that you can do related to real estate finance. And I thoroughly enjoyed it. I really enjoyed that project. We were working on a lot of very specific projects in Hawaii, mostly with Hawaiian investors, although there were some non-local, mostly West Coast investors that were also involved. And I got to see a lot of lenders across the board who were looking at projects. Now, Hawaii is not often a market that commercial real estate lenders always go to. And so the banks are also extremely strong in Hawaii, and they do a lot of the projects for the local sponsors. So I got to build up a big database of people who were doing projects throughout Hawaii, and that database carried forward with me into my next move, which was in San Francisco. But it carried forward with me so that I had a number of contacts who I had already been in touch with from projects that I was working on for a couple years in Hawaii. When I moved to San Francisco, I was working for a division of General Motors in the commercial real estate investment banking area, which was called GMAC Commercial Mortgage. That company became Capmark Finance and then is now Berkadia. So it's gone through some iterations, and I worked there for 5 years in San Francisco, and that was probably the best environment I have ever worked in. We had mortgage banking capabilities, which meant that we could go out to a number of different lending sources, life insurance companies, CMBS shops, banks, credit unions, pension funds, equity, but we also had our own platform. So we also had bridge debt for us. We could lend as JV equity. We could also do our own CMBS and take that to Wall Street and package it up. And after doing that for 5 years, I went to Booz Allen Hamilton, and I was working with them on some manpower and real estate projects that were scattered across the Pacific in Guam, Hawaii, and Japan. And from there, I came to CBRE, and I was working on their debt and equity platform. And when I was at CBRE, I was acting as a mortgage banker in that capacity. And I did that for 3 years, both in Hawaii and also in Northern California. And then I started my own shop, Guardrail Finance, which is where I am now. And Guardrail Finance, as I said, acts as a mortgage banker. And we also put together real estate equity syndications for various groups, friends and family, and also high income earners and accredited investors.